Very good morning to all of you. Today we have three faculties for the session. First of all, I would like to welcome CS Riyans Ravrani. I would like to request CH Intan sir to please escort our faculty. Our another two faculty, CA Harsh Parikh and CA Jaimin Panchal. Today I have an opportunity to introduce our today's faculty. First I will talk about CS Riyans Ravrani sir. CS Riyans Ravrani, a fellow chartered accountant, is a partner in assurance practice of SRBC and Company. He has post-qualification experience of more than 18 years. He specialized in assurance services covering financial statement auditing and reporting requirement under Indian GAAP and IFRS. His experience includes auditing various listed entities spread across multiple locations in India. He has led the statutory audit of manufacturing sectors like power sector, refining, capital intensive machinery, pharmaceutical, etc. He is a certified data analytics expert and IFRS accredited professional in the firm from last few years. He is trainer of data analytics tools and implementing new tools in practice. Apart from account and finance, he has also completed a general management program from Indian Institute of Management, Ahmedabad, and alumni of IIMA. I would request CH Intan sir to welcome the faculty with a memento. Another faculty for the day, CA Jaimin Panchal. Jaimin sir has a more than 14 years of experience working in the domain of technical accounting, advisory services, F&A management services, financial and regulatory reporting, F&A transformation, finance controllership, virtual CFO, and audit and assurance. He is heading BSO and AAS practice for Gujarat as associate partner with BDO India. Prior to these, he was working with KPMG and other large accounting firms. He is regularly taking technical accounting training session for clients within India and abroad also. INDAS workshop, diploma in IFRS session, and CP study circle ICI organized workshop and various other forms. Apart from these, he is an avid runner and enjoy running marathons. He has finished 4 Ironman 70.3 and multiple times full and half marathon. I would request Chintan sir to welcome the faculty with a memento. Our third faculty for the day, CA Harsh Parikh sir. He is a chartered accountant and MBA, auditor by profession, work with the PwC LLP, experience over more than 13 years, he has also worked on INDAS, IGAP, IFRS client, served a client in automobile, chemical, and other sectors, etc. I would like to request the Chintan sir to please welcome the faculty with a memento. Not taking further time, now I would request CH Intan sir to carry the session ahead. Thank you.
Second session of the today's conference on EMA, INDAS. So there is always saying in the mind that INDAS is not for me. So today our job is to ensure that India is for all of us. And that's why we all are here. All the panelists, faculties here, they are having a lot of experience on conversions from ES to INDAS. And friends, this topic is not INDAS, I will say it's an accounting future. Accounting standard, even accounting standards are going to change as per the INDAS over the period. See, World there are primary two gaps. One is IFRS, second is IFRS for SME. So same way we also AS and Ind AS. But however, they both try to converge with each other. So probably, so today what is there under IFRS or Ind AS for accounting standard for a small company or small enterprise also, it is going to align over a period on the same momentum. So આજે અમારો જે objective એવો છે કે obviously we are going to discuss about how can we converge to Ind AS. Additionally, we also want to see that there are a lot of opportunities. If we just talk about my own firm, I have one CA employee who was working on Ind AS convergence in our firm. He shifted to Australia. He moved to Australia. He got a job immediately in IFRS. You are learning international accounting. You are not supposed to be stick to only a particular country. You can be employed anywhere if you know international. So anything where the word is international, that means is a future. Whether it's taxation which is international, or which is accounting international, or GST which is kind of international law. So they all have a huge future perspective for all of us. So what we have tried to have this kind of, initially everybody will speak for a couple of minutes, basically on Ind AS and the topic in general. Then we have identified a very important practical questions which are really relevant when we all have dealt with Ind AS convergence. And the objective is that instead of have one-way discussion, we would like to have discussion interactions where the practical issues which are faced by a lot of corporates can be responded well with practical examples through question and answer. So I know Ind AS is generally આપણે લાગે કે બહુ complex છે, પણ we are trying to make it as simple as possible. As you are aware that Ind AS is a main principle based standard where fair value is how fair is fair value is again a question for all of us. And all laws and regulations in world have been moving towards principles, because you cannot define every simple thing in law or regulation or in a standards, because the way the transactions have been structured, there cannot be response to every structured transactions in accounting. That's why the only thing which can survive is a principle, and that's why the IFRS or Ind AS is something which is very critical. So not taking much time further, I request to start with Shreyans B to share a few minutes, and then Jamin B and Harsh Bhai.
Okay, good afternoon everybody. Thank you Chintan Bhai for organizing this session. So just to start with, as he rightly said, that Ind AS is not all about a very theoretical part, but it is a very practical standards which has been adopted by India almost 6 years or 7 years by now. The key takeaway or the basic important part of the Ind AS is that it works on the principle of substance over form. Anything in substance, what does it reflect? What is the nature of transaction? How the transaction is structured? That is the most important part of the Ind AS. That anybody who want to converse to the Ind AS, they have to look at the substance of the transaction rather than the form. At times it might be possible that we'll go through the examples that debt can become equity or equity can become debt. So there are various principles around this. So that is first part. And second part, I always tell many times Chintan Bhai that this is an opportunity for all the young chartered accountants. See what happens that when you enter into a profession, you have all the stalwarts who are there with an experience of 40, 50, 60 years. So their experience matters. But at the same time, you have a new standard like Companies Act 2013 when it came. My boss said that this is the point where you and me are the same. Both have to start afresh. So same thing is for the Ind AS, that we have to start afresh with an open mind, and there is a lot of opportunities available. I know almost every company, whosoever has converged to Ind AS, has taken the support of the practicing chartered accountants. So within next 1 hour, we'll try to go through the practical aspect of it, and let's see how does it works. And if you have any questions at any point of time, please raise your hand and feel free to ask. Thank you. Jamin Bhai.
Thank you, Shreyas Bhai, and thank you, Nikit Bhai, for the introduction. Thank you, Chintan Bhai, for setting the context, and Shreyas Bhai for setting the context for the today's session. And very happy Christmas to all of you. Merry Christmas to all of you, and a good afternoon. So as we know, the topic for today is demystifying the Ind AS. I would start this with setting the context that what is the applicability of Ind AS so far as India is concerned. We know that all the listed companies as well as the companies who have already having more than 250 CR of the net worth are already on Ind AS. And those companies who are the subsidiaries, joint venture or associate of the company who are under Ind AS are mandatorily under Ind AS. Ind AS are the converged IFRS, which is the International Financial Reporting Standard. With that, how it will be important for all of us to pay attention to what are the changes that is coming so far as the accounting framework in India is concerned. Why Ind AS? When we say we have a IGAP, the old GAAP, which is also called the Indian GAAP, vis-a-vis the Ind AS, which is the converged IFRS. I put the relevance here. The first relevance is how many of you are willing to work with new clients who are going to come and set up their entity in GIFT City or IFSC framework, which is just 30-40 kilometers away, right? Only 1% from the entire lot. There's a lot of opportunity coming out there. Even a branch which is being set up of all those IT and the financial institution companies, which may be two-employee company or a branch, okay, or a separate legal entity being set up in the GIFT City or IFSC framework, regulatorily, compulsorily, they have to follow IFRS. I'm not saying Ind AS, it is IFRS framework. Now imagine, a company which is set up with a 5 lakh of equity share capital, having only few transactions on a monthly basis with its holding company outside the SEZ or IFSC zone, your client, and they need to follow IFRS. Isn't it so relevant for all of us to know IFRS? I'm not saying Ind AS, it is IFRS, because there's a big difference between Ind AS and IFRS when we really sit down and find out various differences between both of them. The Ind AS financials of any listed company cannot be considered for listing in Luxembourg or listing in NSE. They need specific IFRS financial statements because there are carve-ins between Ind AS and IFRS, and that's why it is important to know that all Ind AS financial statements are not equal to IFRS financial statements. So first and foremost, not only those clients which are huge in its size are required to apply IFRS or Ind AS, but at the same time, we all need to raise our standard to, learn and earn our clients who are going to follow IFRS standards. That is first thing. The second is the local bodies, municipalities, government, authorities, etc. How many of you know about the GASAB? It's a body by the government established before 2009. And for the last 10 years, they've been into the implementation, or rather, stage of writing the government accounting standard. There are already 4 accounting standards, government accounting standards. These all principles are based on the International Government Accounting Standard, again getting the analogy from the IFRS. I would say that our IGAP, the old GAAP which we have studied, okay, are easier than this GASAB government accounting standard, which is more akin to what is the IFRS or Ind AS we are having right now in the nation. So understand, you are having clients who are government body, local body, municipalities, right? A government organization. You do audit. Are we looking at double entry, single entry, cash to accrual, conversion, etc.? These principles come from IFRS. This is the relevance of IFRS and Ind AS, and that's the reason those who are present right now, it is very important for all of us to start from here, that how do we learn the Ind AS with the current applicability of IGAP. With that, I just set the tone for today's session. We are going to discuss a lot more on practical aspects around some of the key standards which are more relevant and applicable in the current industry scenario. And over to Harsh Bhai for his setting the context. Thank you.
Thanks, Jamin Bhai. Good afternoon, everyone. There's just one thing that I wanted to add, is that the IFRS and IFRS-based financial statements, these represents the accounting language that is understood globally, right? As India integrates with the global economy, right? There was a time when foreign companies used to set up business in India. That's still going on. Nowadays, we also see Indian companies going abroad and setting up businesses. In this context, I think it is very important that we all understand what IFRS and IFRS-based financial statements are. Thank you.
So I think we already set a tone for the purpose of panel discussion. And just start with the question answer session. Start with Shreyas bhai. And whenever we received assignment for convergence of financial statements from accounting standards to Ind AS, so first step she's already taken is just look at financials. Financials go through kariye, and financials ma obviously profit and loss statement ma OCI is one of the component where we discuss in detail. But however, we also look at the balance sheet side, and balance sheet ma we just look at a term borrowing. Do we have a long-term borrowing or not? And long-term borrowing hoy to ek બહુ જ ઇમ્પોર્ટન્ટ કન્સેપ્ટની વાત કરવામાં આવે હંમેશા, અને એ છે કે EIR, કે ભાઈ EIR પ્રમાણે એ ઇન્ટરેસ્ટ થવું જોઈએ કે ના જોઈએ. એ કન્સેપ્ટ્સ ઇટ ઇઝ કોલ્ડ ઇફેક્ટિવ ઇન્ટરેસ્ટ રેટ મેથડ. સો લોંગ ટર્મ બોરિંગ ત્યાં આગળ જોવા મળે એટલે અમને થાય કે ભાઈ નાવ દેર ઇઝ અ પોસિબિલિટી દેર ઇઝ સમ કાઇન્ડ ઓફ એડજસ્ટમેન્ટ. કારણ કે ઘણીવાર શું છે, AS ટુ ઇન્ડ AS મૂવની અંદર વી સ્પેન્ડ લોટ ઓફ ટાઈમ એન્ડ એફર્ટ્સ ટુ આઈડેન્ટિફાય ડિફરન્સીસ, જે હાર્ડલી બહુ ઓછા હોય છે. બટ યસ, વી નીડ ટુ સ્પેન્ડ લોટ ઓફ ટાઈમ ટુ અન્ડરસ્ટેન્ડ કે એમાં ડિફરન્સીસ છે કે નહીં. સો EIR ઇઝ વોટ, એન્ડ બેઝિકલી વોટ ઇઝ ધ લોજિક and reasoning of having these AS and Ind AS differences. And second thing, how can we practically apply this concept when we move to converge from AS to Ind AS? And today when we're talking about, right now we are trying to have a session where practically આપણી પાસે કેસ આવ્યો હોય અને આપણે Ind AS કન્વર્જન્સનું ડિસ્કશન કરવું હોય ક્લાયન્ટ જોડે, એટલીસ્ટ બેઝિક લેવલ સ્ટાર્ટિંગ કરવું હોય તો શું કહી શકીએ આપણે? So that is what we are trying to provide. Shreyas bhai, so can you just throw a light on EIR concept, relevance of thereof, and particularly how to compute that?
Sure, Chintan bhai. I think, see, taking the first question of ERI really set the context of Ind AS transition. EIR, simple terms might talks about effective interest rate. Now, as I said, that what is this entire Ind AS or IFRS framework is on the concept of called substance over form. Let us take directly practical example. There are two borrowers from a bank, or one party is borrowing from two banks. One bank is charging you 1% processing fees plus 7% rate of interest, for example. At the same time, the other bank, for any reason, wants to pre-earn his income. They charge 4% processing fee only and 4% rate of interest. Effectively, both the banks are taking 8% overall. In practical આપણે જોઈએ તો, but at the same time under AS the accounting will be processing fee might go to P&L and the interest cost of 4% will come in annual financial statement, whereas in the case of first company 1% will go to P&L and 7% will come as an interest cost. So effectively when we look at the financial statement of both the companies, it looks like the first company has a higher rate of interest, has a higher debt paying responsibilities, which is 7%. In the case of second company, it is 4%. But if you go by the substance of transaction, effectively in both the cases, the interest cost is almost same. So to mitigate those differences, the EIR has come into picture, which is called effective interest rate. So by the term itself, it shows what is effective. Actually, ketlu vyaj aipu tukma. So when we compute the EIR, it's not only the interest cost, but any processing fee, loan processing charges, whatever has been given by the company is inbuilt into the entire accounting. Now, in terms of numerology or number ma apne baat kariye to, company has taken a loan of 100 rupees. In my example, it has given a processing fee of 4 rupees, correct? So what happens that you get a loan effectively of 96 rupees only, whereas you are paying interest of 4% on 96, or 4 rupees on 96. So your rate of interest will be much higher. And this is how the ERS calculate that you have to take what amount of the borrowing has been actually received and what is the gross interest which is being paid over it. In both the cases, you will see that your rate of interest will come more or less the same. That is one part of the borrowing, as Chintan bhai said. And the objective of this EIR is nothing but to bring out the same cost into the P&L or same income into the P&L, how different this transaction is structured. કોઈ પણ રીતે transaction structure કર્યું હોય, but effectively it comes into the same way. Like for example, an effective interest rate is equally applicable for assets as well. For example, we have taken a property on rent. Okay, we have to pay a security deposit of, let's say, amount, the security deposit was of 10 lakh rupees, and you are paying interest of, let's say, monthly rent is 5 lakh rupees. Normally, be a Menani security deposit. So your rent expense will come to 2 lakh rupees in your P&L. But what will happen to the 10 lakh rupees of the security deposit? That security deposit is refundable to you after 5 years. So effectively, you are foregoing the interest as well in that security deposit. So what the standard says, okay, today you have given them 10 lakh rupees security deposit. After 5 years, you will get 10 lakh back. What is the present value of 10 lakh today? Assuming 5 lakh rupees. So the balance difference of 5 lakhs will be charged as a interest cost in your P&L. At the same time, if somebody is not ready to pay the security deposit, his rent will be increased. Maybe 5 ni jagah 5.5 lakh thai. So what happens in nutshell, both the parties are paying the same amount, one in form of interest and foregoing the interest and rent, and the other one is just paying the cash rent. So the idea of effective interest rate is just to make sure that the cost and the income in the P&L comes at the more or less the same level, however the standard is structured. There are different varieties and variations in the effective interest rate, but the basic concept is nothing but to make sure whatever adjacent cost is incurred or associated with the transaction, giving interest-free security deposit, giving your processing fees, or foregoing any interest. Let's say example, last example I'll take, if you have invested in a debentures of a company, of a subsidiary company, wherein you will say that after 10 years I will take the same amount back. 100 rupees no tama debenture aje ena issue kaira, you paid 100 rupees. It is 0%. But there is nothing called 0% in this world. The interest is always inbuilt into it. So what happens that you have to determine the present value of that 100 might become 50 or 60 rupees, and the differential 40 rupees will come as a cost into your P&L over 4 years. So that is called effective interest rate. And I don't see this as a more of a theoretical part, because this is how we also negotiate in our real life. If I were to buy a property, I will say that I will pay higher rent if you don't charge me interest-free security deposit, and if you are charging me interest-free security deposit, then I will pay a lower rent. So somewhere I am compensating him for the total rent overall, either by foregoing the rate of interest income on my security deposit or by giving him the higher rent. I think this is all about Chintan bhai from my side of effective interest rate. Very basic, but the core concept is the cost which is hidden in the transaction has to come out into the P&L through the route of effective interest rate.
Exactly. And I think what he mentioned, that both example, over the period, the cost is same. પણ જ્યારે આપણે એ EIR concept apply કરીશું ને, then what happens, cost is equally amortized over the particular period. Equally doesn't mean actually equally. Over the based on the reducing balance method, એ પ્રમાણે જેટલું પણ મારું cost છે, that is be amortized over the period. Now in processing fees, what happens, it is in the first year in which the loan has been received, in the same year 100% cost is charged in accounting standards, which is not correct. So my profitability of the next future years is being impacted only because of decisions which is taken the current year. So that principle is considering time value of money, and over the period of the loan, the amount has to be amortized. That is being driven here in this concept. Now, taking it further, I think there are very different concepts which has been used. Ha, bolo please.
So in that case, if it is, just to go in detail, there are two concepts, either fixed rate of interest or what you are saying is a variable case. In case of ECBs, it is always LIBOR plus 50 basis point, or at time in India, it is a primary lending rate plus 300 basis point, correct? Then in those cases, only the processing fee has to be adjusted. Otherwise, your moving average will be what the bank is giving you. Correct. Whatever your the rates which are charged by the bank is your effective interest rate, because you are dealing with a third party. Correct. Number one. Number two, The only question remains, what do I do with my processing cost? So generally what people do, that they amortize the processing cost over the period of the loan. So the charge is taken, as Chintan Bhai said, in an equal amount, and at times it is not only on the equal amount. Let's say if I have paid 2 rupees of processing fees on 100 rupees, correct, I have paid 2%. So if and let's say the tenure of the loan is 10 years. So if I rationalize it by every year to 20 paisa, then it is not wrong, because my borrowing is getting reduced. So the burden of processing fees on year 1 is higher, the burden of processing fee on year 2 is lower. So this is how it is being inculcated. So overall it makes a basket of effective interest rate, but if something is variable, then let's not touch it. Something which is fixed, that is what it has to be amortized over the period of loan. No, that cannot. My first answer is no, but to me it looks little bit surprising, because doing pledge and doing giving on lease are two different things, correct? Nobody will restrict you to lease out. If you can pledge, it's your owner, you are the owner of the asset, and you can very well pledge it. But if there is such a strict and harsh condition that even you cannot lease out, there might be something different reasons before we conclude it. But prima facie, the opportunity cost lost is not comes into the effective interest rate.
Yeah, so just to add here what Shreyansh mentioned, that if the sublease is not allowed, and in general all properties are allowing sublease, so then we need to just look at whether not allowing sublease would have an impact on fair value or not. See, ultimately this is not like basically one short answer to every question. But however, there may be n number of conditions in lease agreement. See, we can't go look at every condition to see whether it's going to impact or not impact. Is it material or not material? If all are providing and one is not providing, that probably it may have impact on rent. If it is there, it is material, consider, otherwise don't do it. Now taking the further, I think thank you so much, because we want this kind of questions. We also want that more interaction, more discussion is the need of our, and this complex or so-called complex topic can be learned only when we have more discussion interaction. Again, what we do, we are also going to touch upon AS and Ind AS both. Even though it's on Ind AS, but just to understand this concept, we are also going to move from AS to Ind AS. So you are also able to know AS point and then Ind AS point. So under Ind AS, there is always a called short norms like FVTPL, FV2OCI, then fair value. So sometimes the topic becomes complex because no one understands the acronyms of XYZ. If I just want to make it complex, it's easier to say XYZ kiya humne, what is XYZ? So it is the terminology which has been used frequently in Ind AS, and if you want to learn what is most important for all of us, that we also have to understand these acronyms. Particularly in financial assets, classification of financial asset which is there in most of the companies, where the investment can be classified into FVTPL or FVTOCI, then without reclassifying, with reclassifying. This makes more complex. So, Jamin bhai, question to you, that what is the logic of making this complex? Investment simple રાખો ને બાપુ. આપણે આ બધી વસ્તુમાં કેમ FVTPL, FV2OCI, with reclassifying, without reclassifying, and પછી એનું relevance શું છે? We all want to understand that whether they want to keep this practice only for certain class of people, that's why they make it complex, or there's some logic behind that?
No, absolutely. There has to be a logic behind it. See, I truly believe that IFRS is a principle based, and there is always a logic behind what the principle states the accounting. Forget about the companies. Let's talk about ourselves. બધા ઇન્વેસ્ટમેન્ટ્સ કરે છે? ફિક્સ ડિપોઝિટ્સમાં કયા ઇન્ટેન્શનથી કરીએ આપણે? ટુ અર્ન ઇન્ટરેસ્ટ અને પછી છેલ્લે એને મચ્યોર કરીને રિડીમ કરી દેવાની ફિક્સ ડિપોઝિટ? Equity investments શેના માટે કરીએ આપણે? What is the intention? Capital appreciation is one intention. Second, dividend income, right? Okay. Investment into the debt instrument, interest. And at the end of the term, you get the redemption, whatever is the terms and all. Now, if this is the logic behind your investment into any of the instrument at an individual level, that will determine what you will do with the contractual cash flow that you are going to earn out of it over a period of holding your instrument. Isn't it? Right? આપણે individually તો P&L બનાવતા નથી, but otherwise from the company's standpoint, if we look at it, the company would also have a intention of investing into various financial assets. What are the different financial assets? Right? From the investment standpoint, they invest into the equity, they invest into the debt instrument. Account receivable is also a financial asset. There are n number of examples so far as balance sheet from the asset side we see. They will fall under a financial asset definition. Now, what is the principle behind which the accounting will follow? Whether it should be accounted or whatever is the, the price or the value which go increase or decrease, what will be the accounting principle? That is what determines whether it will be FVTPL or FVOCI or amortized cost. So now I come to the concept. The concept is very easy. What is the business model of the company or intention of the company to invest into various instruments or a financial asset? If the intention is to hold till its maturity and earn the contractual cash flows. So in case of fixed deposit, the contractual cash flows are interest that is going to earn on a periodical basis as per the terms of the instrument. And at the end of the maturity, you will get the fixed principal amount. That is the intention. Then this intention is more of an investment intention and not a trading intention. So accordingly, the standard says that if that is the case, right, then you can recognize whatever interest you earn as, or the entire instrument can be classified as fair value through OCI or at amortized cost. Both the options are available. In this scenario, it will be amortized cost. Now, coming back to when it is FVOCI and when it is FVTPL, there is another concept called SPPI, solely payment of principal and interest. This is defined in the standard. Now, this talks about the same, that whether you are going to hold the instrument to earn principal as well as interest. If that is the intention, then you have a option to do it at an amortized cost. Now, what is amortized cost is something what Shreyas Bhai has already discussed. From the loan side, he has discussed. But in the others books of account, it will be investment. And that investment is going to accrue interest. And that accrue interest on amortization chart will be accounted at a amortized cost. So that is one thing. Now coming back to investment into the equity. Now when a company is investing into equity, not necessarily all the companies are going to pay dividend, right? And the second is when they are exiting from that investment by selling of the equity, right? If there is a relationship between holding company and the entity in which they are investing is a subsidiary or associate or a joint venture, then it will be out of IFRS 9/Ind AS 109. It will be accounted as at the cost, or the company can choose a fair value option as well. If they choose a fair value option, then it will come again under Ind AS 109 and it will be FVTPL. So every periodical closure of the reporting period, if there is a change in the equity value of the fair value, then whatever increase or decrease will route through P&L if they have chosen FVTPL. If it is cost, it will remain at a cost, but only in case it is an investment in the subsidiary, joint venture or associate. That is the option under Ind AS 27. Now coming back to those investments which are not falling part under this category, but investment into the equity. then it always be fair value through P&L. So all the investments in the equity will always be FVTPL. Now coming back to the debt instrument. Again, debt instrument, the SPPI criteria that I mentioned, solely payment of principal and interest. Again, it will have a two subcategory. One is, I am holding a debt instrument. I have an intention and a business model to earn the interest, which is a periodical interest, as well as at the maturity, I will redeem it. Then it will be fair amortized cost. If I say that, no, in between of the entire holding period, I will sell that investment and liquidate it. And I will earn the principal upfront if it gets the better value or out in the money. In that case, your intention is two. One is interest as well as selling the investment in between. In that case, it will be fair value through P&L. So this is how fair value through P&L, amortized cost, and fair value through OCI are the three categories under which the investments or the financial assets are generally divided. And the accounting principle and the measurement principle will be accordingly applied. So it comes from the business model, intention, the SPPI criteria, the way it is assessed based on the different terms and conditions of the instrument in which you are investing into it.
Thank you, Jamin bhai. I think this will be a very clear investment financial asset will be classified into FVTPL, fair value through P&L account, FVT OCI, amortized cost, આ ત્રણ મેઇન છે. હવે સમજાય કે ના સમજાય એક ક્વેશ્ચન પૂછી લે તમે લોકોને. આ બહુ સિમ્પલ વસ્તુ છે. આઈ એમ શ્યોર કે આજે આ સેશન પત્યા પછી તમે બધા ઇન્ડિયાના એક્સપર્ટ થઈ જવાના છો. એ સમજી લઈએ આપણે કે રીતે પોસિબલ છે. સો એક એક્ઝામ્પલ સિમ્પલ આપીએ કે રિલાયન્સ ઇન્ડસ્ટ્રીઝના કંપનીમાં એ શેર્સમાં ઇન્વેસ્ટમેન્ટ કર્યું હોય, રાઈટ, અને એ ઓબ્જેક્ટિવ એવો છે કે ભાઈ શેર્સમાં ઇન્વેસ્ટમેન્ટ કર્યું ઇક્વિટી શેર્સની અંદર, તો એ કંપનીના ફાઇનાન્શિયલ્સમાં એ મારે ઇન્વેસ્ટમેન્ટ ઇન રિલાયન્સ ઇન્ડસ્ટ્રી શેર્સ એ મારે કેવી રીતે મેઝર કરવાનું, FVTPL, FVT OCI કે amortized cost? હા બોલો. FVTPL. Any other question? Any other answer? Sorry, any other answer? ભાઈ ઇન્વેસ્ટમેન્ટ ઇન ઇક્વિટી રિલાયન્સ ઇન્ડસ્ટ્રીના શેર્સમાં નાખું ઇન્વેસ્ટમેન્ટ કેમ? આઈ વોન્ટ ટુ અર્ન. સી ઇક્વિટી ઇન્વેસ્ટમેન્ટમાં મેં ઇન્વેસ્ટમેન્ટ કર્યું, દેટ મીન્સ આઈ વોન્ટ ટુ અર્ન ફ્રોમ ધ ફ્લક્ચ્યુએશન ઇન સ્ટોક માર્કેટ. ગુજરાતમાં જેટલા બી લોકો હોય આજે એવરીબડી ટોક્સ અબાઉટ સ્ટોક માર્કેટ ઇન્વેસ્ટમેન્ટ, અને ઓબ્જેક્ટિવ સ્ટોક માર્કેટનો શું છે? ટુ અર્ન ફ્રોમ ધ પ્રોફિટ ફ્લક્ચ્યુએશન્સ. સો બહુ સિમ્પલ, બહુ ક્લિયરમાં જેબીનભાઈ વન્ડરફુલ કે ઇન્વેસ્ટમેન્ટ ઇન ઇક્વિટી ઇન્સ્ટ્રુમેન્ટ હોય તો FVTPL હોય, અને એમોટાઇઝ કોસ્ટ અને FVT OCIમાં ઓલ વી હેવ ટુ લુક એટ ધ બિઝનેસ મોડલ એન્ડ ઓબ્જેક્ટિવ. So it is driven primarily from the objective business model, not by way how you want to show your profit in financial statements. So taking further now, I think we already discussed and about FVTPL, FVT OCI, SPPI, again one more term which Jamin bhai added here, and talking about one very, very important terminology which is the heart of a profit and loss statement. જ્યારે આપણે પ્રોફિટ લોસ સ્ટેટમેન્ટ જોઈએ ને ત્યારે ઇન્ડિયાની અંદર પહેલું ઉપર બધું સેમ લાગે આપણને. જ્યારે નીચે આવીએ ને ત્યારે લાગે આ શું છે નવું, અને ત્યાં આગળ આપણે વી લૂઝ ઇન્ટરેસ્ટ. ખબર નથી પડતી ઇન્ડિયા ડિફિકલ્ટ છે, કોમ્પ્લેક્સ છે, આના કરતાં આપણું એ સારું છે, ચાલશે કરીને. સો દેટ ઇઝ OCI, અધર કોમ્પ્રેસિવ ઇન્કમ. તો વિચ આર ધ કોમ્પોનન્ટ્સ ઓફ OCI? અગેન વન. સેકન્ડલી, આઈ ઓલ્સો વુડ લાઈક ટુ અન્ડરસ્ટેન્ડ that what is the reason of creating a separate OCI? AS બહુ મને એવું લાગે ઘણી વાર લાગે છે AS સારું હતું, શું જરૂર છે આ બધું ચેન્જ કરવાની? તો જો કે રીઝન હશે તો લેટ અસ અન્ડરસ્ટેન્ડ રીઝન વાય દે વુડ લાઈક ટુ ટેકલ વિથ ઓર ટિકલ વિથ ધ પ્રોફિટ લોસ સ્ટેટમેન્ટ ટુ હેવ OCI separately. So can you please throw light on that part?
So I'll start by saying that it's a very simple concept, right? But unnecessarily, for some reasons, it has been made quite complex. So just imagine you are an investor and you are looking at a profit and loss statement, right? And there is one company where there is real profit, as in profit from arising from business operations, as in sale of goods, right? And there is another company where they have profits arising from their regular business operations, like sale of goods. Plus, they also have some notional gains and losses sitting in their profit and loss statement, right? I mean, what would be, which is the profit and loss statement that you would like to actually base your decision on? probably it's the first profit and loss statement where there are no notional gains and losses sitting, right? This is kind of summarizes what OCI is. So when we say a statement of profit and loss, at least under Ind AS, we have a single statement where we have this statement of profit and loss, and below the line, that is net profit after tax, we have this OCI. Now, OCI refers to those notional gains and losses that an organization makes while doing the business. Right? So if you look at the nature of OCI items, they are like revaluation of PPE and intangible assets. They are remeasurement gains and losses arising on actuarial valuation of post-employment benefit plans. Then it arises from translation of financial statements of foreign operations, or the company may have designated some of its equity investments as fair value through other comprehensive income, right? So there are some 9 items which some of which are mandatorily to be routed through OCI, and in some cases you have an option to treat this as OCI item. So having a single statement of profit and loss where you have profit and loss items as well as OCI is to give the investors an idea as to what are the real incomes and what are the notional incomes. Some of these may get routed to the profit and loss in future. Otherwise, OCI as such is a part of other equity, right? So it's the notional gains and losses that have been parked in the balance sheet. So that is primarily all about OCI. If we extend this further in terms of how this is relevant to us, then I think we'll also have to bring in some of the provisions of Companies Act, right? So when you look at the definition of net worth, right, it is quite clear. It says that only those profits which are routed through statement of profit and loss would be considered for purpose of calculating net worth. So OCI, as I said, is not strictly part of profit and loss. It is notional gains and loss which have been parked in other equity. So when you are computing net worth as per Companies Act, you should not be considering OCI for the purpose of this calculation. Very important is the definition of free reserve. So free reserve, as you know, is relevant when you are going to make decisions on whether to declare dividends or not, or whether you have to issue bonus shares. So if you look at the definition of free reserves, in case of free reserves, it says that notional gains should not be considered for computing free reserve. Now, it is not explicit about whether the losses should be considered or not. So what could happen in this situation is that I'll give you an example. So for example, a company has accumulated profit of around 100 rupees, right? And say it has negative OCI of 90 rupees. And it makes a decision to declare a dividend of 15 rupees. What is likely to happen is that there could be a situation of potential capital reduction. Now, this is an interpretation of the definition of reserves, but I believe it would be conservatively appropriate to adjust OCI losses as well when you are calculating free reserves. So I think that was about OCI.
Yeah, thank you. Harshbhai, I think you just try to make the concept of OCI simpler. And it actually, when you just discuss about net worth, that net worth may not or does not include OCI. What is a practical question which I have received every time, that in profit and loss statement is the heading of the statement. OCI is a part of the statement. So profit as per profit loss statement includes OCI component. Plus net worth, when we mention, it is equity. And equity includes OCI. Then net worth should also be include OCI component.
So I think you can also go back to IFRS where you can get some guidance on this. So there are 2 options available when you have to present OCI. Under IFRS, either it could be a single statement where you have a statement of profit and loss and other comprehensive income, and in totality it is named as a total comprehensive income. Or you can also have a separate statement for OCI. right? So, and when you look at the definition of net worth, it says that all notional gains and losses are not to be considered for the computation
Exactly.
of net worth.
Right. So basically, I think even though it is a part of profit and loss statement, how the definition of net worth itself mentioned that unrealized gain or loss not to be considered. That is the reason why it has been excluded. But does that mean that there is unrealized gain or loss in FVTPL, which is part of profit and loss statement, that also to be ignored?
That is some subjective interpretation
Okay.
involved over here. But again, that is not realized. And see, if you look at the definition of net worth, it does not say that what is there in OCI should be excluded. It says that unrealized notional gains and losses have to be excluded.
Exactly.
So, even other unrealized gains and losses which are sitting in your statement of profit and loss, that too should be excluded while computing net worth.
Correct. Fine. So I think, one of the very, very important change when we move from AS to Ind AS, which you will find in 95% of companies, is a gratuity liability. Actuarial gain or loss or remeasurement gain or loss is one redefined terms. In gratuity is something which is a part of my OCI thing. So when we move from AS to Ind AS, please consider to have a reclassify component of a gratuity cost in two parts. One is in OCI and another is profit loss statement. Another very important adjustment which has been seen, and the way the corporates are structuring themselves, having a subsidiary, holding company, and subsidiary are generally depending upon the holding company for the purpose of loans and other things, is to they get a guarantee. So subsidiary company gets a loan not because of their own net worth. They get loan because holding company provides a guarantee to bank. In case my subsidiary company fails, then I will make a payment. So whether do you means this is actually out of the balance sheet transaction. It is not going to affect my parent company which is given guarantee. But why the Ind AS requires to have this kind of transaction to be part of my books of accounts? Shiaz bhai.
Yes. Okay. So as you rightly said that there are a lot of off-balance sheet transaction where effectively you don't give any cash, but you give a support in kind. Correct. Let's say, for example, holding company giving a guarantee to banker of the subsidiary company that give the loan to my subsidiary company, and if there is a default, I am there to take care of it. Now, again, going back to the basics of the Ind AS or IFRS, as Jaimin Bhai told and I told, that there is a logic behind every set of accounting treatment under Ind AS of IFRS number one, substance. So first question which we should ask ourselves, will I give guarantee to anybody in the world? No. Second question, then to whom I will give the guarantee? I will give a guarantee to the subsidiary company. Now, if I go a step back, how do a holding company gives a guarantee? They have to have some credit limits, they have to have some credit limits from the banks, correct? That you can give guarantee to anybody in the world of, let's say, of 100 rupees, and out of this 100 rupees, you give the bank guarantee of 50 rupees to your subsidiary company. So, and the other part of it, if the guarantee is not given by the holding company, and the company goes in the market and take the guarantee from any third party, how much will it cost? It might cost anything between 0.25% to 2%, generally, which is called a guarantee commission. At times, practically, it happens that you have to give a performance bank guarantee to your customers. If you are a supplier of a capital intensive company, then you get those guarantees from the bank, PSU bank or public sector or private sector banks, and they charge guarantee commission of 0.25%, 0.5%, 1% or 2% effectively. So what the holding company is doing in this transaction is waiving of that 0.1% or 0.25% or saving that cost as a group. When parent is giving that guarantee to the subsidiary company, effectively he is not charging anything, it's a cost-free guarantee, and so they are saving 0.25 or 1%. What Ind AS says that any kind of consideration given, any kind of benefit given from one party to the another party should be recorded in the books. So here in the holding company, what is it is happening that there might be an investment of 1 lakh rupees only, but there might be a bank guarantee of 100 crore to take the loan by that company. Effectively, the cost of that guarantee in the market is, for assuming it is 0.5%, 50 lakh rupees. So the subsidiary should have paid that 50 lakh rupees to the holding company, and this should have come as an income. but holding company has waived off that money. So in nutshell, the holding company has given 50 lakh rupees investment to the subsidiary, and the entries which comes in the books is investment account debit to the financial liability of 50 lakh rupees. Why liability of 50 lakh rupees? That tomorrow if something goes wrong, I have a fair value of this guarantee. I believe that my holding subsidiary will never default, but still there is a fair value of that liability, and that has to be accounted for. How does it get squared off? The moment that guarantee gets over and there is no default, then that liability goes into the income. So in nutshell, investment account debit and guarantee account or guarantee income credit over the period of years. Now the tricky part in this entire guarantee account is many times people don't account this assuming this 0.5% only. It is immaterial, but this 0.5% is for a year. If the guarantee is for 10 years, then you are waiving off 100 crore into 0.5% into 10 years means 5 crore rupees of the investment, and therefore materiality, if it is material, you have to account for this as an investment and show it as a financial liability. That's point number one. Now when it comes to subsidiary, what does it does? See, this is another dilemma of Ind AS. Every accounting is not a mirror accounting. The other party has taken a borrowing of 100 crore from its bank. Effectively, their liability is only 100 crore rupees only. So they will not account equity account debit, or guarantee received account debit to your equity, because your actual liability of 100 crore is already sitting in the books as a borrowing to the bank. If tomorrow the default happens, then 100 crore might be going to the bank by the subsidiary company or by holding company. Effectively, subsidiary has not to pay anything to the holding company, and hence no transaction comes into the holding company. So the basic premise is whatever is being paid either in cash or in kind has to be accounted as an investment in the books of the holding company. The common mistake which I have seen is that suppose that guarantee has been given by the has been received by the subsidiary company. Now you show this as a borrowing in the subsidiary company, and there are no assets in the subsidiary company, correct? Will you show this as a borrowing as a secured or unsecured? The common answer that it is a secured borrowing, because the guarantee is given, but the guarantee is not given by the subsidiary. It is given by the holding company. So guidance note of Schedule 3 by Institute has clarified that unless and until the assets of the borrower are placed, any other assets being placed, that doesn't make that loan as a secured loan. So effectively, it can get as an unsecured loan, and we have got QRB queries as well on this, FRRB query, that why are you showing secured? I said, we were conservative. So that let's do what is right. There is no need to be conservative. And the third angle, Chintan Bhai, to this entire guarantee scenario is, most of you might be aware, in October 23, GST Council came out with a very interesting analysis that any corporate guarantee given by one corporate to the another corporate, there, or with the same logic applies, that you are giving him some benefit. The value of benefit you might not have decided. At times you say that there is no guarantee commission. So GST Council said no, that cannot be the fact. You are giving some benefit. So the value of the benefit was considered as either actual guarantee commission or 1% of the total guarantee value. Any upper 18% GST has to be paid. So in nutshell, the government is saying that every guarantee carries a value of 1%. So now most of my clients are in dilemma, those who have proven in past that the guarantee commission for the subsidiary could have been 0.25%. So I will see what is my 0.25%. 0.25% will always be material, so I will not do the accounting. But now government is saying minimum 1% to thase, the upper hase to that's your choice. So this is how the entire game. So whenever you see any, and the second objective of raising this GST is that at times it is not only the accounting which affects. At times your GST, your income tax may also get impacted by the what value of the guarantee you are accounting in the books.
Shreyas, I think you touched upon a very relevant point and practical October 2023, which you mentioned. And I believe that the government has learned from our Ind AS accounting.
True.
Because whenever I suggested to client about this guarantee fair value, they do accounting, and when a GST audit comes to picture, they are asking to charge, they are asking to levy GST on that part, and then we really try to explain them. See, Ind AS is difficult. Many CAs are unable to do it. How the government officers of GST they will be able to understand Ind AS. So what is happening now that let us understand this situation a little bit more detail, because we need to really get answer to this question. First thing is that Yeah, I'll come to your question. You want to ask question? You want to ask question? Okay, yeah, please. Just a minute. So let me just complete, then we'll go on that part, right? So on this guarantee part, basically what we're discussing, for example, 0.25% is what the fair value which is identified to be guarantee fees. Now GST department says 1% is what they do it. On other side, from guarantor company, we have done accounting. From subsidiary company, where you show us income, you not shown his income.
Correct.
So then how to rectify, reconcile, or practical way is that let us have fair value of 1% and show in both subsidiary holding company on constitutional knock off, government is happy, and even no one understand, matter is over.
So what happens in console that at times there are various entries under Ind AS which are one-sided entries, correct? And so in consolidation, this will completely go as a consolidation adjustment. Neither there will be any financial liability at the standalone at the console level, nor there will be investment at the console level. So both the items will get wiped off or nullified or go away in the consolidated financial statement, correct? There cannot be any obligation or investment between companies at the console level. So that gets eliminated clearly in the consolidation financial statement. Now coming to what Chintan Bhai is saying, either it is 0.1% or 0.25%, it's very difficult to even, I have seen, most of the time what clients do, they get some kind of documents from the bank that my only question that how do you establish 0.25%? I said, okay, let me go to my bank and I'll ask a quote from my bank, what my bank will charge. So bank gives in writing that if 100 crore guarantee joye so I will charge you 0.5%. So that means this is a fair value of the transaction which a third party is giving you. Still GST guys says 1%, then we have to honor it, or if the amounts are so high, and in many corporates it's are so high, imagine a corporate like Reliance or anybody, Tata's or Vedanta, because their entire businesses, every subsidiary, every newborn company needs support in day one. So the amount of the corporate guarantee is not only in crores, it is lakhs and billions of crore today in India. And I was just computing the amount of revenue which GST guys will come. Imagine 1% of that into 18%. It's humongous amount. Huge. But that's the law of land and we have to respect it as a 1%. But certainly there can be a different consideration in the accounts if the clients are able to establish it is 0.25 or 5, anything below 1%, then there are supporting documentary evidence, then we have to respect it.
Also, you can respond to his question.
Yeah. So you are saying, see, when I talked about guarantee, it's not a guarantee for bank, correct? Any kind of support given to suppliers, let's say a kind of support which is given to the supplier that if my subsidiary will not pay for a year or two, then I will pay you, correct? Those kind of, but it's very difficult to come out with this kind of documentation in the off-balance sheet item. The only thing where you can know is might be some kind of board of minutes or any kind of subsidiary holding summary of the transactions. That's the way you can get a one. And why normally the Ind AS is more stressing on the banks, because it's very difficult to figure out in case of banks, because the moment you have given the guarantee, it will come in your bank confirmation, you will come to know what are the off-balance sheet items. But a kind of written understanding given to any third party, which it doesn't appear or prima facie is not coming everywhere, it's very difficult to case. So it is more of a kind of whatever assurance or whatever support which has been given, either to a bank or to a third party or to the suppliers for support of the money which has been payable by subsidiary.
Fair enough, I think.
Chintan bhai, just to add what he's saying and to answer his specific question on off-balance sheet examples. See, leases is the classic example of off-balance sheet, right? From the old to new, right? And that came from airline industries, where the entire model of aircraft industry is always on leasing, okay? The second example is at the time of business combination, right? When you acquire any entity, there are a lot of liabilities which are considered as a contingent liability. Or there are a possibility of having some intangible assets like brand, okay? Like IP, like customer contracts. These are always, not accounted. They are kind of off balance sheet because of the business combination. It come and surface on the balance sheet afterwards. So there are the few typical examples which are, bang on there. The world has seen this, this type of impacts in 2015-16 when we transit from IGAP to Ind AS majorly. on most of the listed companies. Thank you.
Yeah, I think just to what he mentioned about lease, and particularly, for example, if a Tata Motors has moved factory from from that Singu to Sanand, at that time there are a lot of small automobiles spare parts vendors they also moved facility to Sanand. And from India's point of view, always would like to discuss that: do we need to really look at how the agreement is structured? What is the dependence of these automobile vendors on Tata Motors? The rate at which they are providing, the facility which is provided by Tata Motors, maybe it may include some rent or some facility. Probably what happens that the structuring may be done in such a fashion that rent agreement may not be separately done. And however, or rent which they are charging very less charging. But however, the supply cost may be different costs. So there can be a combination of various elements possible. So studying of agreement and contract is one of the best thing which can be done. Have review or understanding of the contracts. Once you understand contracts and agreement structuring, then I think we are able to separate the elements out. And that is the reason why the new standard of Index 115, Index 16, they talk about separation of elements. Jamin B also discussed about business combination. So I think Jamin B will let us move towards on that particular line. So control. AS3 Indies, when we move, one of the most important thing change is the definition of control. Whether we do consolidation, is it by subsidiary or not, and also with respect to the acquisition. The control definition is very critical thing, and why it is very important, because India's 103 business combination, which is extension or very much extensions to AS14 accounting for amalgamation, which talks about fair value. And આપણે કેવું છે fair value જ્યારે બી આવે ને ત્યારે આપણે લાગે અરે રે આમાં શું fair value ની જરૂર છે. So Jamin bhai, આપણે let us have discussion about that if there is acquisition happens, in which cases it will be qualified to be definition of control, and if it's control definition qualified, how the accounting will move from AS14 to India's 103. Also, if you can touch upon Appendix C of India's 103, because common control transactions are again a very, very critical aspects in today's situation. How it is going to impact?
થોડો લેન્ધી આન્સર થશે, ચાલશે ને? Generally, control definition is ખાલી છે ને, I take 1.5 hours whenever I take any index, 110 or 103. It's that much in depth. And as I started with, it is always a principle based as compared to the rule based. Earlier AS21 માં જે આપણે rule based we were following, like more than 50% of the stake is taken by the holding company. પછી 50% થી એક શેર પણ વધારે હોય તો by rule based we say it is my subsidiary without looking at any other aspects around it. And when you have a majority of the board of directors, then you say that it is my subsidiary, right? What happened is, you know, if this type of situation is that the other party who is also having the equal number of directors or, you know, 49.99%, they say that ki bhai hamari subsidiary cha. So then what happens in a practical scenario, and we have seen this, okay, in most of, at the time of 2015-16, a lot of companies were doing this. And the concept says that that has to be unilateral control, and that cannot be a situation when two of them or two companies say that this is my subsidiary, the other party also says this is my subsidiary. So that is one important aspect to note before I start the control definition. So from the control standpoint, it has to be a unilateral control. Otherwise, there has to be a joint control. And when we say joint control, it goes to the joint venture. The accounting is totally different and separate, and the definition is also a little different there. Now, coming back to the control, what do we mean by control? As I said, it has to be unilateral control. It is a principle-based and no more a rule-based. Then, what determines a control is something needs to be looked into. There are various steps to look into it. One is, again, the intention, the objective of the business in which the investment is being made by one entity to the another entity. Why it is important is, let's say for an example, let's say at the time of Vodafone and Idea merger, okay, it was a merger, we know. It was more of a joint venture, now we know. But at that time, I was a part of the entire transaction. There was a dilemma whether Idea is acquiring Vodafone, Vodafone is acquiring Idea, or it is a joint venture or a jointly controlled entity, right? This was a very, very basic questions, but it required humongous efforts to come out and analyze and finalize that how transaction is really be accounted, whether it's a subsidiary or joint venture type of relationship. Now what has gone into it? Let's think. A telecom industry. What are the main objective of a telecom industry? Is to seamlessly provide the data connection and the network connection with all the value-added services is the first primary objective. The second is, what is most important for them is the auction of the wavelength spectrum, right? Huge amount that they spent. The third is the entire infrastructure, tower, etc., right? Now that's how, these are the critical activities, important activities through which a business function, and it function for the objective. The end objective is to provide the services, at the same time to earn profit also. At the same time, giving value-added services to give the last mile connectivity to earn that goodwill also in the minds of the customer. So then there are so many important activities that a business does in which industry it belongs to. That means what is the objective behind the industry is functioning, whether the investment is made looking at this objective or not. That is the first. Second, now I understand what is the investee or the company in which I am making investment. So as to say that these are the n number of activities which I want to have participative right or want to influence the decision or want to control it. Why I want to control it? So as to earn something out of it. Now what I will earn? Variability of return. What is variability of return? It's not always profit. Profit anyways is going to be a variability of return. Dividend is always going to be a variability of return. There could be losses also. There could be the benefit of the brands that I am going to get it, the customer relationships that I am going to get it. So by influencing or taking participative decision rights into those important activities, what I am achieving is getting exposure to variability of return, and this return can be plus and minus, maybe tangible, intangible. Now what I am doing is, I know I am going to invest into this entity with this purpose, and I want a decision-making rights onto it. Now this entire thing is written in a very technical jargon in Ind AS 110 for the control definition. It is extended to Ind AS 103 business combination as well. It says that power over relevant activities which gives exposure to variability of return, and there has to be a linkage between power and the variability of return. If this is established, then you can say that I have a control over that entity, and if you have a control over that entity, it becomes your subsidiary, and that's why it says that it has to be a unilateral control, and it cannot be two companies controlling and saying that both of them are having a subsidiary there. Now, this is one is the way I have explained in a very easy manner. The second is the definition, the way it is written. The third is, this definition is further giving a lot of guidance that how to really establish this principle and take a decision and do the assessment around it. See, rule-based આપણું જે accounting IGAAPમાં તો એમાં બે વસ્તુ હતી, board of directors અને equity share capital, right? 50% થી વધારે હોય એટલે you can take decision. Board of directors majority હોય, you can take decisions. But it is more of a rule-based. As I said that in 2015-16, we have given a lot of companies that this has to be your joint venture and not the subsidiary, and they did that impact. And the impact was what? Impact was that company was consolidating line by line and having a 50% of the turnover added, 50% of the asset base added. એ બધું જતું રહ્યું day one accounting માં. And now what they have is only equity pickup of 50% of the profit and loss. That was the major impact between this type of situation. Now coming back to what Chintan Bhai said is, you have to read all the contracts, agreements, arrangements, MOUs, whatever has been done between two entities at the time of assessing this control, right? Why it is relevant? One is through the equity participation, you get a control. Definitely more than 50% will give you, right to vote for various relevant activities. But you have to determine what are the relevant activities. Those will come by way of your shareholders agreement or the arrangement that you are having. Within the shareholder agreements, you will have different types of terms and conditions. We divide that into two parts. One is the substantive rights and the second is the protective rights. Simple example of protective right is debenture trustee appoint thata hoy છે જ્યારે debentures હોય. Just 2 minutes, right? So debenture trustees are having a protective rights when anything comes in the board of directors decision making situation, so that the interest of the debenture holders are saved. Similarly here, there are a lot of protective rights which are given in the agreements. And there are substantive rights which directly impact the variability of the returns, like whether we invest into the capital, new projects, whether we go for introduction of new products, new geography. Even, now I would say that the appointment of a auditor, okay, in some of the situations still can be considered as a substantive right, considering today's scenario. Earlier, straightway, we used to say that appointment of auditor is always a kind of a protective or a other right as per the contractual arrangement. So this has to be divided into two parts and give a weightage to. Second is how this is being, exercised by the entity, by the board of directors, by the chairperson as a veto right. These all are required to be looked into from the exercise of the rights perspective. And then comes as the one aspect is a de facto right. Now what is a de facto power is, let's say I am investing in an entity at a 35% of the stake, but the other 65% is dispersed. It is a listed company and dispersed across so many shareholders. They will never come together and vote me out. That at 35% also I can say that it is my subsidiary and I control that entity. So there are a lot of aspects so far as control definition is concerned. The primary principle is the definition, principle based, looking at the contractual arrangement with how it is being exercised in the past, maybe reading of the minutes, the other arrangements they may have, like a long-term supply contract, majority contracts, which influence various transactions, and how I will determine this aspects to earn my variability of return. If yes, it's a control and it becomes my subsidiary.
વન્ડરફુલ. જમીનભાઈને એવું છે ને કે ભાઈ આ એમનો ટોપિક એટલો હાર્ટની નજીકમાં છે કે કદાચ એમને આપણે આખો દિવસ આપીએ તો આખો દિવસ આ જ ટોપિક પર ડિસ્કશન કર્યા કરે. અને વી હેવ ઓબ્વિયસલી ટાઈમ લિમિટેશન અને લંચ પહેલાંનો આ સેશન છે મને ખબર છે. તમે બધા લોકો બહુ જ ઇમ્પોર્ટન્ટ છો મારા માટે, બિકોઝ જે જનતા છે એમાંથી આટલા લોકો બચ્યા છે એન્ડ વી વિશ કે તમે લોકો પણ એમાં રહો, એટલે યુ આર જસ્ટ ટેકિંગ ઇટ ફર્ધર અહેડ. અને હી મેન્શન અ વેરી ઇમ્પોર્ટન્ટ પોઈન્ટ કે જ્યારે બી વેન વી મૂવ ફ્રોમ એએસ ટુ ઇન્ડિયસ, વી આર સીન ઇન લોટ ઓફ કંપનીઝમાં જ્યાં આગળ કંટ્રોલ સ્ટ્રક ડેફિનેશનના કારણે હ્યુજ ચેન્જીસ થયા છે. એન્ડ ફ્રેન્ડ્સ, ઇટ હેઝ અ હ્યુજ ઇમ્પેક્ટ ઓન કોન્સોલ ફાઇનાન્સ સ્ટેટમેન્ટ એન્ડ સ્ટેન્ડ ઓન બોથ. કારણ કે લાઇન ટુ લાઇન કોન્સોલેશન આવે અને પેલામાં ના આવે ઇક્વિટીની અંદર, તો પ્રેક્ટિકલી બહુ મોટો ઇમ્પેક્ટ થઈ જાય છે. અને ઘણા બધા પોઈન્ટ્સની ડિસ્કશન કર્યું. ફ્યુ ક્વેશ્ચન આ હે, બટ બિફોર દેટ એક હર્ષભાઈ જે ક્વેશ્ચન તમને પૂછવા માગું છું કે ભાઈ એએસથી ઇન્ડેસ કન્વર્ઝન, આ બધા લોકો બેઠા છે ને એ લોકોની પાસે નાના ક્લાયન્ટ્સ મોટા ક્લાયન્ટ ક્યાં હશે. જેવીનભાઈ પહેલાં વાત કરી કે ભાઈ ગિફ્ટ સિટીમાં પણ બધા જ લોકો 5 કરોડ ટર્નઓવર હોય ને તો બી બેઝિકલી આઈએફઆરએસ કરવું પડે. તો એઝ અ ઓપોર્ચ્યુનિટી દેર ઇઝ અ પોસિબિલિટી કે સ્મોલ ક્લાયન્ટ ગમે તે આવ્યા આપણી પાસે કે મારે એએસથી ઇન્ડેસ કન્વર્ઝન કરવું છે, એએસથી આઈએફઆરએસ કન્વર્ઝન કરવું છે. લેટ અસ હેવ અન્ડરસ્ટેન્ડિંગ બેઝિક ફ્લો ચાર્ટ, પ્રોસેસ ફ્લો, સ્ટેપ બાય સ્ટેપ પ્રોસેસ ફ્લો જોઈએ મારું ઓવરઓલ કે મારે એએસ ટુ ઇન્ડેસ કન્વર્જન્સ કેવી રીતે કરવાનું એ સમજાવો.
થેન્ક્સ ચિંતનભાઈ. આઈ થિંક આ જ એક નોન ટેકનિકલ ક્વેશ્ચન છે. રાઈટ, સો before we talk about steps, what I would like to highlight is some experiences or conceptions or misconceptions about conversion from IGAP to Ind AS. So first and foremost is that it is not a job of a person or a function, say finance function. I think there are organization-wide ramifications when you are planning to move from IGAP to Ind AS. You also have to be very mindful about the fact that you have to educate and train your staff and also to the board of directors. Often the amount of efforts that are required in conversion are not properly estimated. Also, the impacts that could be there on account of Ind AS conversion, that is also underestimated. Too often what I have noted is that people are very late to start, right? I mean, they would then have to rush through all the activities, and they are then not in a position to derive the value out of the entire exercise, right? So I think you have to keep this thing in mind before you actually embark on this journey of conversion from IGAP to Ind AS. Now, if I have to be specific about steps, I would say broadly there are 3 steps, right? One, I would say, is plan and assess, right? Another is, I would say, implement, and third is monitor or sustain, right? So this does not always go sequentially. Too often there's an overlap between first and second step and the second and third step. So when I say plan and assess, what I'm trying to say is that at the very beginning, you should have an understanding about what are the potential impacts of conversion to Ind AS, right? There could also be tax implications on account of this conversion. That too has to be deliberated carefully. Further, this would have impact on your processes and controls and the financial systems. And accordingly, you would also need to think how this is going to impact the overall organization. To be more specific, while planning out this thing, you have to ask certain questions to yourself and get answers to it. The first and foremost is, what are the major gap differences in terms of reporting and accounting policy choices, right? Whether the conversion would have any impact on your ability to raise capital. That is one another question that you have to think. You also need to understand what are the kind of skill sets that you have. Also, whether this is going to impact the way you are executing your business. At times you may have to revisit the contracts and maybe even modify the contracts that you have executed to ultimately get the desired results, right? And as I said, this is organization-wide. So at the start, you have to have a coordinated effort covering not only finance, right? There would be implications on HR. There could be a role of legal, right? Information technology is also very important. You may also need to revisit your control framework to meet your risk management objectives, right? So considering this, you have to have a detailed roadmap at the beginning, right? And most critical is to engage with all the stakeholders, which would also include your audit committees and board of directors, and also the auditors who are ultimately going to audit your books of accounts. Moving to the next stage, that is this implementation stage. Here you exactly figure out what are the gap differences and how you sort out any potential tax impact on account of conversion from Ind AS, from IGAP to Ind AS. Also at the implementation stage, you are expected to prepare necessary documentation, right, in terms of the workings that are required. Say, for example, you are adopting Ind AS and there are a lot of leases, right? There will be a lot of calculation that would be involved. You have to be ready with those working, because those workings and memos, those are the documents that would demonstrate that you have thoroughly gone through it, and those would be used by the auditors while they are auditing the financial statements. The last stage is relating to sustaining and monitoring, right? I mean, this is probably the most neglected stage, but I believe this is perhaps the most important stage, in the sense that if you look at India's history since last 6 years, when we have adopted Ind AS, we had Ind AS 115, then we had Ind AS 116. In 2 years' time, we'll also have Ind AS 117. So all the training and education, that is not something that is going to be only at the beginning when you transition to Ind AS, right? Regular upskilling of your staff is very important. Also, the data flow through your controls and processes and the changes in IT systems, that also needs to be very regularly monitored. So unless you have a thoroughly developed roadmap, I think you will be missing out on certain important values that the exercise may bring to you in terms of overall reduction of cost of implementation or standardization or centralization of certain functional activities. So all I'll say is that if these steps are not carefully designed and executed, right, this may end up becoming a reactive exercise and maybe just a compliance exercise.
Thank you so much, Harsh bhai. I think a lot of discussion we have done on technical topic, but at the end, that was very, very important for us to have a brief overview. I won't say it's like detailed one, brief overview of steps from conversion from AS to Ind AS. Friends, when you discuss about technical issues, we also have to be aware about the disclosure requirement under Ind AS. There are extensive disclosure requirement, at least in Ind AS 109, 107, and 110, 112. So we have to be also aware about these disclosure requirements. But yeah, it's not something which is which we can ignore. We have to learn, and we have to start from somewhere. So my wishes to all of you. Before I close, two word of thanks. Any questions on any of the points on AS or Ind AS? You can also question on AS, because these all faculties are also dealing on account standards, Ind AS. So anything which you feel are practical issues, we can have this discussion.
So Chintan, I just want to make a point,
Please.
right? So whenever you're planning to move from IGAP to Ind AS, I think you have to start way early, right? I mean, at least 1 year, probably depending on size and complexity of the business, it has to be more than 1 year, because there are far-reaching implications and you need to know them beforehand rather than worrying about it at close to the reporting timelines.
Correct. Okay, any questions? You want to add something? Yeah, please. Yes, yes.
If you take the examples of the industry right now, let us take Oberoi or Prestige. They are doing 8 point of time, and the reason for that 8 point of time, see, Ind AS 115 says that at what point of time the supplier has transferred the obligation. What is a performance obligation? When it has been supplied, correct? And there are 3 conditions to that. One is that whether the person is enjoying the benefit or not, the asset which is being constructed is being of value to the other person or not. And at the same time, the third and the most important part is whether is there any alternative use or not for the other person. Now what is happening in the real estate is, no problem, I think this. In case of real estate, the biggest clause which is changing from at a point of time to over the period of time is a cancellation clause. Let's say if the property is 50% constructed and the buyer can cancel it, that means the control over the asset, which is the basic premise of the 115, is not transferred. And to take it little bit further, Chintan Bhai, is that, and the real evil is not the Ind AS here, the real evil is RERA. Because practically what is happening, that when, I know I've been associated with few companies who are doing this Ind AS transition 115 and this over the point of time, period of time, the RERA mandates, in India, RERA is a state-wise subject, correct? So various states mandates RERA that there has to be a cancellation clause in your agreement. So you cannot, no builder can go away without the cancellation clause in the agreement, except Maharashtra RERA, which doesn't mandate this. So if you pick up Oberoi, their few properties are over the period of time because they are all in Maharashtra and they are over the period of time, there is no cancellation clauses. Whereas Oberoi group has other properties which is in another states of the India, you take Bangalore, you take Ahmedabad, there is a mandatory clause, and that too with a mandate that you cannot charge penalty beyond 10%. So even if the person has paid you, the person has constructed for you 50%, but you are not going to compensate him for the entire 50%. You can leave away or move out of the property by just paying 10%. So unless and until you effectively get reimbursed from whatever you have done, you cannot do POCM. That is the crux of the subject.
No, I think wonderfully explained. But the most important thing I will suggest that there is a ICI guidance note you must have gone through also. It also explained these all concepts because cancellation clause, if not, then what? They also mentioned, they also made POCM open. See, because what happens before this guidance note, it was certain that they had to go by completion method. First guidance note and complete picture, they have given a separate example, illustration. It mentions that there is also possibility that you can do POCM, and thereafter a lot of companies have started POCM. So both are possible. In my view, cancellation clause is there, but we also have to look at substance over form. Because only a form should not, because when you talk about RERA provisions, RERA requires that it should be there, it is there, but what is substance over form, that is more important than only cancellation clause. So with this, I think I'm ending here because we already surpassed the time of 1 p.m., which is the lunch time, and you can do anything but not lunch time. That is the most important thing. So before I close over, I am really a heartfelt thanks to each one of the panelists. They all are a speaker by themselves. Everyone speaks 2 hours on a session. However, we would like to have a practical discussion, interaction, just to make it more interesting. However, if it had been only one-way session, having one person speaking on 2 hours, probably we may not be able to have this kind of valuation. So that's why they all accepted my request to come here. So my thankful to Shreyans bhai, Jamin bhai, and Harsh bhai. Let's have a big round of applause for them. Thank you all of you once again, and we can have discussion over lunch. Thank you.